Hi everyone, my name is Kevin Hornbeek, and today my partners and I will be presenting on managing supply chain risk. Today's discussion will be about hedging raw material price fluctuations with derivatives. We'll be focusing on how companies, especially in manufacturing and construction, use financial tools like futures and options to protect themselves from rising raw material costs. So, why do some companies hedge raw material costs, and who is most affected? Prices for raw materials like oil, steel, cocoa, and lumber can change suddenly. These changes hurt profits, delay projects, and increase overall costs. Industries like manufacturing and construction are hit hardest because they rely on large quantities of materials. Hedging is used to stabilize costs and reduce financial risk from price swings. What are derivatives and how do they help in hedging? A derivative is a financial contract whose value comes from an underlying asset like oil, copper, or wheat. Futures, an agreement to buy or sell a commodity at a set price in the future, and these are mandatory, by the way. Options are the right to buy or sell at a set price, which are optional and they're more flexible. They let companies lock in costs early, helping manage budgets, even if market prices rise later. So, how did Hershey use futures contracts to manage supply chain risk? See, cocoa prices are very volatile, so Hershey uses futures contracts to lock in cocoa prices. This protects them from price spikes, which could ultimately raise chocolate production costs. In 2023, Hershey reported a $460 million gain from commodity hedging. This shows how futures help a company stay profitable during supply chain stress. So our next example is in the construction industry. How can a construction company benefit from hedging lumber prices? See, construction firms buy lumber futures when they know they'll need wood for a project. If prices rise later, then the profit from the futures contract offsets the higher material costs. This allows them to plan and stick to budgets even in an unstable market. It's a key way construction firm controls costs and reduce risk on large projects.
Why do companies want to hedge against fluctuations in raw material prices? Companies hedge against fluctuations in raw material prices primarily to protect their profitability, stabilize costs, and reduce financial uncertainty. Raw material costs often make up a significant portion of a company's cost of goods sold. If the price of key inputs like steel, oil, or lumber rises unexpectedly, it can erode profit margins, make finished products more expensive, and reduce competitiveness. Hedging allows firms to lock in prices, making cost forecasting more reliable. This is crucial for annual budgets, long term contracts, and project planning. Without hedging, prices swings can lead to budget overruns or force companies to renegotiate contracts. It can also mitigate supply chain risk. During global disruptions like COVID-19, prices can become extremely volatile, sometimes jumping 2 to 3 times what they used to cost in just a couple months. Hedging provides a financial cushion and keeps operations running smoothly even during instability. Hedging with futures is a financial strategy used to lock in prices of a raw material or commodity that a company plans to buy or sell in the future. It protects against adverse price movements in the commodity market. A futures contract is a standardizing agreement to buy or sell a specific quantity of a commodity at a predetermined price on a specific date. Futures are a standardizing contract to lock in a future price of a commodity. It's used for predictable material needs. And an example of a future is a construction firm expects to buy 1,000 tons of steel in 6 months. Worried about rising prices, they buy steel futures contracts now. If steel prices go up by the time they purchase, the futures gain covers the price increase, protecting their profit margin.
Okay, so first I'm going to be talking about hedging with options. Options provide the right but not the obligation to buy or sell an asset at a fixed price. This characteristic gives us valuable flexibility compared to full commitment required with futures contracts. For example, the use of the copper call options in electronics manufacturing sector. Companies like General Electric can purchase call options to ensure cost certainty for their raw materials. This means they can lock in a price for copper without committing capital unless prices raise above a certain threshold. If copper prices do increase significantly, General Electric can exercise the option and purchase the metal at a predetermined price, which protects them from higher costs in the long run. Okay, so monitoring and adjusting. In today's market, managing supply chain risk is crucial for maintaining profitability and operational efficiency. One effective strategy for mitigating risks associated with raw material price fluctuations is the use of derivatives. As we know, the market is constantly changing, and so are the conditions that affect our raw material prices. This makes it essential for us to regularly assess the performance of hedging positions. First, I'm going to be talking about performance assessment. By routinely analyzing how hedges are performing, we can determine whether they are effective at mitigating risks as planned. This can include looking at market trends, comparing hedge prices to current market rates, and evaluating overall financial exposure. Next, being proactive in adjusting our strategies. Significant market changes such as shifts in supply and demand or just regulatory changes can impact overall operations. It's crucial that you adapt to hedging strategies accordingly. This might even mean entering a new position, closing existing ones, or exploring different financial instruments. Okay, so next, developing a hedging strategy. A hedging strategy should be tailored to a company's specific needs and risk tolerance as well. So the first step in this would be assessment of exposure. Here we need to quantify the potential financial impact of raw material price changes on our bottom line. This involves analyzing historical data, understanding the market trends, and evaluating how fluctuations in price could affect our overall profitability. Okay, so next, selection of instruments. It's crucial that we choose the right derivatives based on the type of exposure we've identified and the current market conditions as well. Whether we opt for futures, options, or swaps, our choice should reflect both our risk appetite and our operational strategy as well. Finally, implementation. This is where we execute trades to establish positions that will help offset potential losses from price fluctuations. It's important to approach this step with precision and to ensure that our trades align with our hedging strategy that we have developed. Okay, so challenges and considerations. While hedging can be effective, it also obviously comes with challenges. Complexity. Derivatives are often complicated financial instruments that require a certain level of expertise to manage effectively. Understanding the intricacies of these instruments is essential to ensure we're using them correctly and to their full potential as well. Next, costs are really important. There are costs associated with trading derivatives, including transaction fees and potential losses if market movements are favorable. And then lastly, counterparty risk, the risk that other parties in the derivative contract may default, and it's important to check the other party's credit worthiness before fully going into an agreement with them.
Benefits of hedging raw materials. Profit margin protection shields the company from rising input costs, helps maintain consistent production costs even during market volatility, protects margin erosion in fixed price contracts. Improved budgeting and forecasting, locks in future material costs for more accurate financial planning, reduces uncertainty in long-term project budgets, allows managers to plan pricing strategies with confidence. Reduces earnings volatility, smooths out fluctuations in quarterly or annual earnings caused by price swings, helps meet investor expectations and reduce risk premium on the company's valuation, contributes to a more stable stock price and credit profile. supports fixed price contracting, common in industries like construction, aerospace, and engineering, enables companies to offer reliable fixed price bids without risking future losses due to cost inflation, enhances reputation and credibility with clients. Protects against global supply chain shocks, especially valuable during geopolitical events, pandemics, and transportation disruptions. Acts as a financial buffer during periods of inflation or scarcity. And lastly, competitive advantage. Firms that hedge effectively can offer more stable pricing to customers, better positioning versus competitors who may be forced to raise prices or take losses, and increase customer confidence in the long-term supply agreements.